Let's talk about money, specifically saving versus investing. It sounds simple, right? But understanding the difference and how they work together is crucial for building a secure financial future, especially here in the US, where we often have to navigate complex financial systems and plan for things like healthcare, education, and retirement largely on our own. So what is saving? At its core, saving is setting aside money for short-term goals. Think of things like a down payment on a car, an emergency fund, or a vacation. The key here is safety and accessibility. You need to know that money is there when you need it, and you need to be able to get to it quickly. Traditional savings accounts at banks and credit unions are the most common way to save. You deposit money, and it earns a small amount of interest. Let's say you put $1,000 into a savings account with a 1% annual interest rate. After a year, you'd have $1,010. That's great. It's safe, it's accessible, but the growth is slow. Now let's shift gears to investing. Investing is about putting your money to work with the expectation of earning a return over a longer period. It's about growth. Unlike saving, investing generally involves some level of risk. You're not guaranteed to get your money back, and the value of your investment can fluctuate. But with that risk comes the potential for higher returns. Think about things like stocks, bonds, mutual funds, and real estate. Let's illustrate with an example. Imagine you invest $1,000 in a stock. Let's say that stock increases in value by 8% over a year. Your $1,000 would now be worth $1,080. That's significantly better than the $10 you'd earn in our savings account example. But let's be realistic. The stock could also decrease in value. It might end up being worth $900. That's the risk. So why is this distinction important? Because it dictates where you put your money and when. Short-term goals like that car down payment in the next year or two should be funded through saving. You can't risk losing that money if you need it soon. Long-term goals like retirement, which might be 30 or 40 years away, are better suited for investing. You have time to ride out market fluctuations and benefit from the potential for growth. Let's consider a scenario. Sarah wants to save for two things: a new laptop in 6 months and retirement in 30 years. For the laptop, she should open a high-yield savings account. It's safe, accessible, and will earn a little bit of interest. For retirement, she should consider investing in a diversified portfolio of stocks and bonds, perhaps through a 401(k) or an IRA. Now let's talk about how they relate. Saving and investing aren't mutually exclusive, they're actually complementary. A solid financial plan includes both. In fact, many successful investors start with saving. Building an emergency fund, ideally 3-6 months of living expenses, should be your first priority. This provides a financial cushion in case of unexpected events like job loss or medical bills. Once you have that cushion, you can start investing. Think of it like this: saving is the foundation, and investing is building the structure on top of it. You need a strong foundation before you can start building something tall and ambitious. Another key relationship is using investment returns to fund future savings goals. As your investments grow, you can withdraw some of the profits to save for things like a down payment on a house or your children's education. Let's talk about some common investment vehicles. Stocks represent ownership in a company. They offer the potential for high growth, but also come with higher risk. Bonds are essentially loans you make to a government or corporation. They're generally less risky than stocks, but offer lower returns. Mutual funds and ETFs, exchange-traded funds, are baskets of stocks and bonds, offering diversification. Real estate can also be a good investment, but it requires more capital and involves property management responsibilities. Diversification is crucial. Don't put all your eggs in one basket. Spreading your investments across different asset classes, stocks, bonds, real estate, can help reduce your risk. Also, consider your risk tolerance. Are you comfortable with the possibility of losing money, or do you prefer a more conservative approach? Your risk tolerance should guide your investment decisions. Finally, remember that time is your greatest asset. The earlier you start saving and investing, the more time your money has to grow. Even small amounts saved consistently over time can add up to a significant sum. Compound interest, earning interest on your interest, is a powerful force that can accelerate your wealth-building journey. So to recap, saving is for short-term goals, prioritizing safety and accessibility. Investing is for long-term goals, prioritizing growth and accepting some level of risk. Both are essential components of a sound financial plan. Build a solid foundation with saving, and then build on it with investing. Diversify your investments, consider your risk tolerance, and start early. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.